Hey everyone, welcome to this video. Now before we get started, please make sure you have subscribed our channel for more cutting-edge trading strategies. Alright, let's get into the topic. So today I'm gonna show you a cutting-edge trading strategy that combines oscillation box theory and ELM, which is called extreme learning machine. Now you might wonder what these two things are. Let me explain here. So first let's talk about oscillation box theory. The basic idea of this theory is that the stock price always have a certain range in a period of time. So that's why it has a maximum and a minimum price during this time. So imagine there are two ends of a box, the upper boundary and the lower boundary. And that's why it's called oscillation box. When the stock price closes to the lower boundary, it has the rising trend, and on the contrary, close to the upper boundary. Furthermore, the price will go into another box to start a new shock in a range after it breaks through the boundary. So for people who have experience with technical analysis, you can think of it as a support line and resistance line. So if the stock price breaks the support line, there is a high chance that the stock price will continue to go up. And on the contrary, if the stock price goes below the resistance line, it has a good chance to keep going down. And in another case, if the stock price breaks the resistance line, the former resistance line becomes a new support line, and the stock price will keep going up. Okay. Now that we talk about oscillation box theory, let's talk about extreme learning machine. So it's just one of the machine learning algorithm, and the goal is to find pattern for training data and then apply on test data for prediction. So to put it as simple as possible, you can think of it as a human brain. So imagine when you look at historical stock price, how do you predict stock price for today? You can think about it. So normally you would look at stock price 2 months ago versus stock price 2 months ago. And then you would look at stock price 2 months ago versus stock price 1 month ago. And then after you do that for a lot of times, you try to generalize a regular pattern of similarities between stock price at two different moments. So extreme learning machine is essentially simulating human brain. It's just providing a new approach to training the single hidden layer feed-forward network, which makes the training completed faster. So in live trading, many times we cannot afford to use a lot of time to train a model. There are actually better model, we call it deep learning. This model are the most cutting edge model that's available. But then for high frequency trading, like for these trades, we cannot afford too much time wasted on training the prediction. That's why we want to utilize extreme learning machine, because it's much faster. Now let's talk about how we combine the oscillation box theory and extreme learning machine. So we first define our input as a vector. We call it Fi. I here is I state. And since that we are using historical data to predict today's stock price, we can only use the data before today. That's why you can see the K here is actually less than I. It's I minus 1, I minus 2, and all the historical data. And F is about open, high, low, close, volume, moving average, price rate of change, relatively strength index. So these are the input we care about. And then the second step is we define a label. We call it price at I state. and the price can be either highest or lowest. And then we're gonna train the model with input and label using ELM. And then we're also gonna predict the new highest and lowest stock price using the model. And the last step is we put the highest and lowest price back into oscillation box as the new upper and lower boundary. And then we're gonna execute trades using the following algorithm. So it might look a little bit complicated, but I'm just gonna explain briefly here. So here we are essentially looking at if we are sitting at the lower boundary. And then if we are sitting at the lower boundary and the price is at a good price, we're gonna buy it. And then we record the current buy price as CI. And if any time in the future we are close enough to the upper boundary, then we check if our profit is good enough. So this is essentially checking the current price minus our previous buy price is larger than a certain threshold. So we can set this to any number we want. Let's say 15% profit. Okay, it's good enough, then we're gonna sell it. Or if after we initiated our first trade, meaning we bought our price at buy price, and if the stock price has been going down after that, we need to do a stop loss. So that's what we are doing here. We check if we have lost a certain percent of money already, let's say 5%, and we're gonna sell it to stop loss. That's it for the trading strategy. So the performance is better than buy and hold strategy. Now don't underestimate this. If you look into a lot of these very famous hedge funds in US, if you look at AQR Capital, you look at Citadel, like a lot of these hedge funds, they don't beat SPY, meaning if you just buy and hold SPY 20 years ago, you would make much more money than invest with these hedge funds. If you are interested in the detail, I posted a link to the paper in a video comment. That's it for today. I hope you enjoyed the video. Please subscribe, like, and share. That really helps me to keep making more videos. And today I'm just trying to be more academic. I'm trying to introduce more of the cutting edge trading strategy instead of just like a lot of things that everyone knows already. So that's why it's a little bit more complicated, but then I'll try to explain it as clearly as possible. Alright, thank you for watching this. See you next